Most people start an SIP, but very few actually follow the discipline needed to build real wealth. What if I told you there is a simple rule that can make your SIP journey stronger and more rewarding? Hi everyone, Wilfred Sequeira here. Welcome back to the channel. Today we are unpacking the 7531 rule for SIP investing, a smart strategy that keeps you invested longer, better diversified, emotionally prepared, and growing faster every year. Let's break it down. The 7 in the 7531 SIP rule is simple. It means staying invested for at least 7 years. Why? Because markets are always volatile. They go up, they go down, and no one can predict short term movements. But when you stay invested for 7 years or more in equity markets, the chances of negative returns drop to almost zero. That's the power of time. Remember, time in the market is always more important than timing the market. Stay invested, stay disciplined, and let compounding do the heavy lifting. Let me explain the power of 7 with the help of an example. Imagine you plant a seed, you water it, you care for it, you invest in it, but at first it looks small. Nothing seems to be happening, and you start wondering, is this even working? That's where most people make the biggest mistake. They dig up the seed too early. They quit right at the beginning, long before the magic starts. Then comes year 3. There is growth, slow, steady, honest growth. Your money is making a little money. This is the boring middle where patience gets tested and most investors lose confidence. But if you just wait, this happens. Year 7 arrives. The tiny plant is now a massive tree. The small jar of coins has transformed into a treasure chest. The tree is massive. The jar is gone, replaced by a treasure chest. This isn't just savings anymore. This is compounded wealth. The secret ingredient isn't luck. It's time plus patience. Don't cut down your tree before it bears fruit. Start today, stay invested for at least 7 years, and let the magic happen. Most people start an SIP but quit too early, and that's the biggest mistake. Today I am going to show you with simple numbers why staying invested for at least 7 years makes a huge difference. Let's compare 3, 7 and 10 years SIP assuming an average market return of 12% per year. Typical long-term Nifty 50 equity returns. Let's start small. If you invest 10,000 every month for just 3 years, total invested will be 3,60,000, profit 70,000, portfolio value at the end of 3 years will be 4,30,000. Here is the problem. In the short term, markets swing a lot. Your profit is small and you can even get negative returns in a 3-year period. Now look at what happens when you continue for 7 years. Total invested will be 8,40,000, profit will be 5,20,000, portfolio value will be 13,60,000. Notice something. You invested just 2.3 times more money, but the profit jumped 7 times higher. Why? Because real compounding starts accelerating after year 5. Historically, Nifty 50 has given almost zero negative returns over 7-year rolling periods. That means risk drops dramatically. And if you stay invested for 10 years, total invested will be 12 lakh, profit will be 11 lakh 20,000. Portfolio value at the end of 10 years will be 23 lakhs 20,000. You invested just 3.3 times more money, but the profit jumped 16 times higher. Look at that, your profit is almost equal to your total investment. That's compounding in its purest form. So why is 7 years the sweet spot? Simple, because after year 6 or 7, your returns start generating their own returns. Volatility smoothens out and the risk of loss becomes tiny. So next time someone asks how long should I stay invested, tell them this: minimum 7 years. That's where compounding truly begins. 5 means diversifying your investments across 5 different mutual fund categories. Most new investors make this mistake. They pick one mutual fund, put all their money into it, and hope for the best. When everything is in a single fund, one bad phase, one wrong call can damage your entire portfolio. Now look at the right side. This is how smart investors build wealth by diversifying. Different asset classes behave differently. Equity gives long-term growth while debt adds stability. Gold protects during uncertainty and international stocks add global exposure. Real estate brings steady appreciation. When one asset falls, another rises. That's why diversification works. It reduces risk and smoothens your returns. Now, once you diversify across asset classes, the next step is to diversify within equity itself. Equity isn't just one big bucket, it's made up of different styles and each one behaves differently across market cycles. Here is a simple example of a well balanced equity mix. High quality stocks, these are the steady compounders, usually large cap companies that keep growing year after year. Value stocks are solid businesses available at a discount, giving room for strong upside. GAAP stocks, these are growth at a reasonable price stocks, a blend of fast growing companies that are still sensibly valued. Mid and small caps, the high potential category where growth can be sharp and transformative. Global stocks, your window to opportunities beyond India, adding diversification to your portfolio. When these styles work together, they help create a smoother and more resilient investment journey. So remember, diversification isn't just about safety, it's the strategy that builds long term wealth. The 7531 SIP rule sounds simple, but emotionally, most investors struggle with three big hurdles: disappointment, irritation, and panic. Let's understand them. In the first 1 or 2 years, your SIP doesn't grow much. Returns look tiny, markets look slow, and you start feeling disappointed. You think, is this even working? But this is exactly where most people quit, right before compounding takes off. Choosing the right funds irritates a lot of investors. Large cap, mid cap, flexi cap. Should I add international, gold? This irritation leads to overthinking and that leads to chaos. Too many funds, wrong categories, or constant switching. When markets fall, emotions rise. You see your portfolio in red and panics take over. You want to stop your SIP. You want to change the strategy. But the whole point of the rule is to follow one plan through ups and downs. Panic is what destroys wealth, not volatility. So remember, the 7531 rule works beautifully only if you handle the three emotions that break it: disappointment in the beginning, irritation in the middle, and panic during corrections. Master your emotions, and SIP does the rest. Don't stop your SIPs during these times. These phases are temporary, but growth is permanent. The one in the 7531 rules refers to the practice of increasing your SIP amount annually, which is the single best way to accelerate wealth creation. Let me explain this with an example. Sanjay starts a monthly SIP of 10,000. He decides to increase his SIP by 10% every year, aligning it with his annual salary hike. Year 1 10,000 per month, year 2 11,000 per month, 10% increase, year 3 12,100 per month, and so on and so forth. Over a 20-year period, an initial 10,000 monthly SIP with no increase might create a corpus of approximately 1 crore at 12% annual return. However, by implementing the one rule, that is 10% annual step up, his final corpus could jump to over 2 crores, nearly doubling his wealth with the same starting amount. By simply increasing your SIP by 10% every year, matching typical salary hikes, you invest 2 times more money over 20 years and end up with almost exactly 4 times the corpus. No extra magic, just the power of contributing more as you earn more. This is why the step up SIP or rule of one is one of the simplest yet most powerful wealth creation habits in personal finance. Let's quickly recap what we saw today. Starting with Rule 7, invest for a minimum of 7 years. Why 7? Because that's where the magic of compounding really kicks in. Think about it, your money isn't just growing, it's growing on top of growth. Moving to Rule 5, diversify across 5 fund categories. Don't put all your eggs in one basket or one stock. We are talking a mix like equity funds, debt funds, gold, international funds, and maybe some real estate. Now, rule 3, push through the 3 emotional phases. Don't stop your SIPs during these times. These phases are temporary, but growth is permanent. Finally, the big one, rule 1, increase your SIP yearly. Don't just set your SIP and forget it. Bump it up 10 to 15% every year as your income grows. There you have it, my quick summary of 4 rules to build wealth smarter. Hold for 7 years, diversify 5 ways. Conquer those emotions and scale your SIP. Implement all of these and you'll see the difference. That's it for today's video. If you found this video helpful, give it a thumbs up, subscribe for more investing tips, and share it with a friend who is just getting started. So if you haven't started a SIP yet, today is the best day to begin. Thanks for watching and I see you in my next video. Until then, happy investing, happy returns.